Nobody told James the car would cost him $312,000. Not the dealership, not the finance manager who walked him through the paperwork with the practiced calm of someone who does this 14 times a day, not the bank that approved the loan in 11 minutes, not the colleagues who nodded approvingly when he pulled into the car park on a Monday morning in March. The sticker said $34,000. The monthly payment was $520. James ran that number against his take-home pay, decided it was manageable, and signed. Nobody showed him the other number. The $520 a month over 6 years is $37,440 in payments. Add interest at 7.9% APR, and the total climbs to $41,600. Add insurance over that period, $1,400 a year, that is another $8,400. Add annual servicing, tires, and routine maintenance at $1,200 a year, another $7,200. Add depreciation. The car James drove off the lot at $34,000 is worth approximately $14,000 6 years later. He lost $20,000 in value simply by owning it. Total cost of the car James thought cost $34,000, just under $77,000. But that is still not the real number. The real number is what $520 a month invested instead at a 9% average annual return becomes over 30 years. $312,000. James did not buy a car. He chose not to have $312,000 at 62. That decision was made in 11 minutes, with a sticker price designed to make the transaction feel like $34,000 and a monthly payment designed to make it feel like $520. The full number was never in the room. And here is what makes this genuinely alarming. The car is not the exception. It is the pattern. It repeats across every category of ordinary spending: the apartment, the phone, the subscriptions, the wardrobe, and it repeats for one reason: because the average person has never been shown how to calculate what anything actually costs. They see the sticker, they feel the monthly payment, they miss the number that determines whether they retire with options or without them. That number has a name, and once you learn to see it, you cannot stop. My name is Isabella, and I spend way too much time thinking about the mathematics running invisibly beneath every financial decision most people make without ever examining. Before we get into this, I want to hear from you right now. Where are you watching from? And be honest, when you made your last significant purchase, did you calculate the real number, the full lifetime cost, or did you see the sticker and feel the monthly payment and call it close enough? Drop your city or country in the comments and tell me where you are on this journey, whether the car example just made your stomach drop or you already knew this and want to go deeper. I genuinely want to know. I read every comment. And if this is the kind of content that makes you think differently about money, subscribing means you will not miss what comes next. Now, here is the assumption most people carry into every financial decision they make. They believe the price of something is what it costs. The number on the receipt, the figure in the listing, the monthly payment on the contract. They believe that is the transaction. Money leaves, object arrives, exchange complete. Here is the fundamental lie in that assumption. The sticker price is not the cost. It is the entry fee. And for most purchases most people make, the entry fee is the smallest part of what they will actually pay. What James experienced in that finance office and what repeats for millions of people across every spending category every day has a name. Economists and behavioral finance scholars call it the average tax. The concept builds on foundational work by University of Chicago economist Richard Thaler, the 2017 Nobel laureate whose research on mental accounting documented how human beings evaluate purchases in isolation rather than in the context of their full cost or opportunity cost. His work and subsequent research at Harvard and the National Bureau of Economic Research produced a consistent finding. Ordinary people reliably and systematically underestimate the true cost of what they own by a factor of 2 to 4 times. The average tax is the cumulative financial penalty paid by people who live financially average lives, who make the decisions most people make using only the information most people are shown. It operates on your car, your home, your phone, your subscriptions, your wardrobe, and it compounds. Every year you pay it, it costs more than the year before. According to the 2024 Experience State of the Automotive Finance Market report, the average monthly car payment in the United States has reached $738 for a new vehicle, the highest figure ever recorded. The average loan term has extended to 72 months, 6 years, on an asset that loses 20% of its value before the loan is halfway complete. Read that again. Americans are taking 6-year loans on assets worth half their purchase price before the loan is halfway complete. Across a lifetime of average car ownership, the average tax in this category alone exceeds $500,000 for the typical household. Let that sink in. According to a 2023 Lending Tree analysis, the average American household carries $6,270 in credit card debt at any given time. At the current average APR of 24.37%, that balance costs $1,527 in interest annually, just to stay exactly where it is, not to pay it down, just to hold it. According to a 2024 Forbes Advisor survey, the average American spends $219 per month on subscription services. 42% of respondents in the same survey could not accurately identify all the subscriptions they were currently paying for. They were spending money on services they had forgotten they owned. The average tax does not require your attention. It collects automatically. According to research published in the Journal of Financial Economics, households that calculate opportunity cost before major purchases accumulate on average 2.8 times more wealth over a 30-year period than households of identical income who do not. Same earnings, same economy, 2.8 times the outcome. The only variable was whether the full number was ever in the room. Here is exactly how the average tax is collected and why most people never see it happening. Mechanism 1. The sticker price illusion. The human brain anchors on the first number it encounters in any transaction. This is called anchoring bias, one of the most extensively documented findings in behavioral economics, and the entire retail and finance industry is built around it. The sticker price is not just a price, it's an anchor. Once that number is in your mind, every subsequent number is evaluated relative to it rather than on its own terms. This is why $520 a month feels manageable when attached to a $34,000 anchor. Evaluated independently, $520 a month is $6,240 extracted from your financial life annually for a depreciating asset. The anchor made the monthly number feel small, the monthly number made the total cost invisible, and the total cost made the opportunity cost, the $312,000, completely absent from the decision. Think of every sticker price as a magic trick. It makes you look at the number in the magician's right hand while everything that matters happens in the left. But here is where it gets significantly darker.
Mechanism 2. The carrying cost accumulation. Everything you own costs money to keep, not just to buy, to keep. Insurance, maintenance, storage, registration, replacement parts, these accumulate silently, automatically, and indefinitely for as long as the item remains in your possession. The average homeowner spends between 1% and 3% of their home's value annually on maintenance alone. On a $350,000 home, that is $3,500 to $10,500 per year, spent simply to prevent deterioration before a single improvement is made. The average person replaces their smartphone every 2.3 years at $800, producing a lifetime mobile expenditure of approximately $28,000. Carrying costs are invisible because they are distributed. They arrive as a $140 insurance renewal here, a $320 service bill there, a $60 subscription renewal somewhere else. Each one feels like a minor operational cost. Collectively, they constitute the largest category of untracked expenditure in most households. But that is not the worst part. Mechanism 3, the opportunity cost silence. Of all the mechanisms through which the average tax operates, this one carries the most devastating long-term consequences, and it is the one most completely absent from every financial transaction you will ever conduct. Opportunity cost is what you give up by choosing one thing over another. In financial terms, it is what the money you spend would have become if invested instead. It is never printed on a receipt, never disclosed in a finance agreement, never mentioned by a salesperson. A $200 a month clothing budget, below average for most working professionals, represents $2,400 a year. Invested instead at 9% from age 25 to 65, that $200 a month becomes $944,000. A daily $6 coffee purchase, invested instead over 40 working years at 9%, becomes $866,000. Nobody who hands over $6 for a coffee is thinking about $866,000. The transaction was designed to prevent exactly that thought. But here is where it gets really interesting. Mechanism 4, the lifestyle gravity pull. The average tax has a self-reinforcing mechanism that makes it progressively harder to escape the longer it operates. As income rises, spending rises to match it, not through any single conscious decision, but through the accumulated gravitational pull of what feels normal at each new income level. The person earning $60,000 who receives a $15,000 raise does not experience $15,000 of additional financial freedom. They experience $15,000 of lifestyle budget. The apartment improves, the car gets newer, the dining threshold shifts upward, the raise is absorbed before a single dollar reaches an investment account. This is why income growth so rarely produces financial freedom, not because the income is insufficient, because the average tax scales with income automatically, unless deliberately interrupted. Let us follow Marcus. Marcus is a 36-year-old project engineer in Houston, Texas. He earns $87,000 a year and takes home approximately $5,500 a month. He is not a spender in any dramatic sense. He owns what most people would describe as a normal life: a decent apartment, a reliable truck, a professional wardrobe, a handful of streaming subscriptions, a gym membership he genuinely uses. Marcus has $11,000 in savings at 36 after 8 years of earning good money. He cannot explain where the rest went. Here is where it actually went. His truck, financed at 8.1% over 72 months, costs $634 a month in payments, $1,800 a year in insurance, $1,400 a year in additional fuel, and $900 in maintenance. Total annual truck cost, $17,308. Over 6 years, $103,848. The truck will be worth $19,000 at loan completion. He spent $103,848 to own an asset worth $19,000. His subscriptions, streaming, software, a meal kit he signed up for during a promotion and never canceled, premium music, cloud storage, total $340 per month, $4,080 per year. He could identify approximately 180 of it if asked. His dining and social spending averages $1,100 per month, $13,200 per year. He has not calculated this number. Nobody does. Marcus is not living extravagantly, he is living averagely. An average at his income level produces $11,000 of savings after 8 years of professional earnings.
He told himself he would start investing seriously after the truck was paid off. The truck clears in 14 months. Research on spending behavior predicts with statistical consistency what happens next. The $634 freed up will be absorbed into an upgraded baseline within 3 months. Because the lifestyle gravity pull does not release when a debt clears, it identifies the new available margin and pulls. The full cost of Marcus's average financial life, not in dollars spent, but in dollars that will never compound, is $1.4 million. Here is what matters most to understand about Marcus. He is not financially irresponsible. He is financially average, and in a system designed by institutions that profit from average financial behavior, those two things produce identical outcomes. The automotive finance industry earns $120 billion annually in interest from American consumers. The consumer credit industry earns $130 billion in annual interest and fees. The subscription economy generates $650 billion globally, built on the behavioral reality that auto renewal at a low monthly price point reliably collects from people who forgot they subscribed and find cancellation just inconvenient enough to defer. These industries did not become this profitable by accident. They engineered every element of the transaction, the anchor price, the monthly payment framing, the auto renewal default, to ensure the full number is never in the room at the moment of decision. You are not paying the average tax because you lack discipline. You are paying it because you were handed a world of transactions deliberately engineered to collect it, and nobody handed you the calculator that shows the number they chose not to show. Rule 1. Always calculate the full number. The sticker price is not the cost. The full number is purchase price plus total interest across the loan term plus annual carrying costs multiplied by expected ownership period plus opportunity cost, what that monthly commitment compounds to at 9% over 30 years. This calculation takes 10 minutes. It is the most valuable 10 minutes in any financial decision above $1,000. Most purchases that survive the sticker price do not survive the full number. The ones that do are worth making. Do this every time without exception. Rule 2. Audit every recurring charge annually. Once a year, same date, treat it as a fixed financial appointment, pull every recurring charge from your statements for the previous 12 months. Every insurance premium, every subscription, every membership, every auto renewal. Add them. The total will almost certainly be significantly higher than your mental estimate. For most households, this audit reveals between $1,200 and $4,000 of annual expenditure on services that are forgotten, redundant, or significantly overpriced. Cancel what delivers no active value. Renegotiate what remains. 3 hours of work. Compounding annual return. Rule 3. Never finance a depreciating asset at a high interest rate over a long term. The asset loses value from day one. The interest compounds from day one. If you must finance a vehicle, the rules are specific. Loan term no longer than 36 months, interest rate no higher than 5%, total vehicle cost, including insurance, fuel, and maintenance, no more than 15% of gross annual income. Everything outside these parameters is the average tax at full force. A $738 monthly payment on an $87,000 salary is not a car purchase. It is a multi-year wealth transfer to a financial institution delivered in monthly installments calibrated to feel manageable. Rule 4. Calculate opportunity cost before every recurring commitment. Before signing any recurring financial commitment, a subscription, a membership, a payment plan, run one calculation. Take the monthly amount, multiply by 12. Calculate what that annual amount, invested at 9%, becomes over 20, 30, and 40 years. Write the number down. Look at it. Then decide whether the service is worth that number, not the monthly fee, the compounded number. A $50 monthly subscription over 30 years invested at 9% is $90,000. Some subscriptions survive that calculation. Most do not. Make every recurring commitment earn its place against what it is actually costing. Rule 5. Interrupt the lifestyle gravity pull at every income increase. The lifestyle gravity pull collects automatically from every raise and bonus, unless deliberately interrupted before a new baseline establishes. The interruption must be structural and immediate. On the day any income increase takes effect, redirect a minimum of 70% of the after-tax increase to automated investment before it reaches your current account. Not next month, the day it arrives. The remaining 30% can absorb a modest lifestyle improvement. The 70% begins compounding. Within 6 months, the invested amounts becomes the new expectation, and the gravity pull has nothing left to capture. Applied consistently across a career, this single rule produces more wealth accumulation than any investment strategy available to an ordinary person. Rule 6. Replace monthly payment thinking with total cost thinking. The monthly payment frame is the most effective wealth extraction tool ever deployed at scale. It transforms a $41,600 commitment into a $520 decision. It makes the unaffordable feel manageable and the damaging feel routine. The replacement is total cost thinking, a deliberate habit of refusing to evaluate any financial commitment by its monthly number and insisting on the total cost across the full commitment period before any decision is made. This is not natural. The monthly payment frame is everywhere precisely because it works. Resisting it requires one specific, repeated question, not what does it cost per month, what does it cost? That answer changes most financial decisions. Picture yourself on a Tuesday morning 26 years from now. You're 62. The alarm does not go off because you turned it off 3 years ago. Not because you're sick, not because it is a holiday, but because you ran the full numbers in your mid-30s and made every subsequent decision accordingly. The investment accounts have been compounding for nearly 30 years, not through any single brilliant move, through the consistent structural redirection of money the average tax would otherwise have collected. The truck you drove for 11 years instead of 6 freed $340,000. The subscriptions you audited annually freed $80,000. The raises you intercepted freed $420,000. None of it felt like deprivation. It felt like arithmetic. This morning, it feels like freedom. Now, picture a different version of that morning. Same year. The alarm goes off at 6:15 a.m. the way it has gone off at 6:15 a.m. for 38 years. You lived well by every visible measure. The car was good, the apartment was comfortable, the monthly payments were always manageable. But the full number was never in the room, not once, across 38 years of decisions. And the investment account reflects exactly what happens when the average tax is paid consistently across every category, across an entire working life. You needed 4 more years, maybe 5. Which version you inhabit was determined by decisions made with information you either had or did not have. You have the information now. We opened in a finance office where James signed for a car he believed cost $34,000. The real number was $312,000. And James is not unusual. James is average. The average tax is collected from average people in average transactions across every category of average financial life, quietly, automatically, at a scale most people will never calculate because they were never shown how. The rules in this video are the calculator. The question is not whether you can afford to use them. The question is whether you want to be the person who saw the full number and acted, or whether you are comfortable being the person who saw the sticker price, felt the monthly payment, and called it close enough. Before you go, I want to hear from you in the comments. Which number stopped you in this video? Was it the $312,000 car? Marcus and the $1.4 million he did not know he was spending? The $944,000 clothing budget? Drop the number that hit hardest and tell me what you are going to do differently because of it. And tell me where you're watching from. This channel reaches people from Lagos to London, Nairobi to Toronto to Manila, and the average tax operates in every one of those economies. Different currencies, identical mechanism. Drop your city or country below. I read every single comment, and this community is genuinely built in that comment section. If someone in your life is paying this tax without knowing it, share this video with them. It costs you nothing and might change a number that matters enormously for them. If this earned a like, it helps more people find this content who are quietly searching for exactly this clarity. And if you want to keep building this understanding, subscribe, because what we covered today is one layer, and there are several more that compound on top of it. Thank you for being here. Now go find the full number.